Thank you, everyone, and welcome to our webinar today. I'm Sheila Harris, immediate past president of LAI. Gary Leach was scheduled to do our opening remarks, but he's having computer challenges, so he's not able to join us this morning. So hopefully, Gary, you'll get on soon and we can hear from you. But I don't want to take any more time in taking away from our presentation today. It's my really great pleasure to introduce Elliott Pollack. Elliott's somebody I've known for a couple of decades. We worked together when I was at the state of Arizona, and he has and still does have the Elliott D, Pollack and Company, which does a lot of economic forecasting. And he's going to shed some light today on maybe some supply chain challenges we're witnessing, Elliott, and give us a great overview of what's happening in the economy. So without further ado, I'm going to turn it over to you, Elliott. Thank you.
Great. I appreciate being here, and hopefully I'll keep you awake for the next hour. Are the slides up, Sheila?
I see the slides.
Good. Here we go. So hang on. As far as I'm concerned, the economy is going to continue to grow at an above average rate. And so things look good. On the other hand, the rate's going to be erratic based on different situations each quarter. And there are going to be some glitches along the way. It's really an oddity right now. You've got some things that are extremely strong and other things that are trending the other way. So we all know about these big issues. Sheila mentioned supply chain. There's a generalized lack of labor that is not going away quickly. Inflation, which in my opinion is not going to go away this year or next. Which that means higher interest rates. We've had bad government policy. We'll see if that continues. And the effect of all these on housing affordability, which is declining, but is about to be in a free fall. And, you know, whether you're going to have future variants, and there's always some black swan event that I put that in because for all the things that I can't see. So does it look like this? No. The outlook is positive. Don't panic. This is an election year. The Fed is saying this is not 1980, although I have my doubts, but they are not likely to purposely throw us in a recession. Obviously, real GDP is considerably higher than it was before COVID started. On the other hand, jobs is still almost 3 million jobs lower than when COVID started, and we'll talk about that. But also keep in mind, this is not a typical business cycle. This wasn't brought about because the Fed had to slow things down because there were excesses in the economy. The economy was doing fairly well before COVID started. This is a recession caused by the government forcing large parts of the economy, mainly the service sector where people touch one another, come in contact with one another, to shut down. So don't look at other cycles because this is really not the same thing. At any rate, we expect this year to be well above average, and we expect next year to be somewhat above average. So really not a bad outlook. Here's why. Most consumers are not in good financial shape. Most consumers are in great financial shape. There's lots of cash. Debt levels remain low. Jobs are plentiful. There's a positive wealth effect, and there's significant pent-up demand. So things are looking good. Let's take a look at these. First of all, this is 94% of this is consumer cash, and consumer cash is almost 3 times what it normally is. The consumers are awash with cash. While credit is picking up again, it's still below where it was when COVID started. Financial obligations ratio, which this is how much of your income you're using for previously accumulated debt, is the lowest or near the lowest on record. So consumers can handle more debt. Job openings, obviously 11 million jobs, and this is how tough it is to hire people right now. I'll let you look at that for a second. If you don't like this, don't send me an email, thanks. And yet the number of people unemployed is considerably lower than the number of jobs that are available. And this is really the first time in American history this has happened. And this is why quits are so high, because jobs are so plentiful. And obviously layoffs are lower than they've been in, in years and years. Even unemployment, initial unemployment insurance claims are almost the lowest on record. The stock market, while down the last week or two, effectively is still very high. Obviously, people who own their home are feeling a significant positive wealth effect. And yes, consumer confidence is down. This is a Conference Board measure, but there's reason for it to be down, mainly because of inflation. But all right, let's talk about the labor force for a minute. The labor force came back and more recently has come back fairly strongly, but is still way below where you would expect. In fact, in January, 47% of NFIB members reported job openings that they could not fill. And the number of unfilled jobs exceeds, it's almost at a record level, and it exceeds the historic average of only 23%. Well, here's where workers are. The participation rate has dropped fastest among women, workers without a college degree, and those in low-paying service jobs, hotels, restaurants, childcare. And one of the reasons is during COVID, they were simply paid to stay home. And the adverse incentives are still affecting a lot of people because jobs are available. If you can't find a job today, quite frankly, you probably don't want to work. As a group, those people over 55 are better prepared for retirement. They saw their 401k, they saw their house go up in value, and they said, I'm only going to work for another 2-3 years. I think I'll pull the plug now. And so you have acceleration of retirement. And I think that will continue unless the stock market really tanks. Those who have skills who have eroded during COVID may not return, and women will still have childcare issues. First, it was that schools weren't open, but now it's the number of childcare workers is much lower than it was pre-COVID, and they might not return. It's a difficult situation for a lot of women. Some people won't return to the labor force until COVID is completely under control. And right now it looks like that'll be soon, but there's always the risk of another variant. I read a lot on that and I am totally confused. Even with the expiration of the enhanced unemployment benefits, many have saved so much money from various stimulus programs that they don't need to return to work yet. And beware of incentives not to work that are in what will be introduced in pieces, but essentially is the Build Back Better program. And we'll see what happens, because all these things, by the way, spell higher wages and increased prices. So not everything goes according to plan. We all know that. But consumers have rarely been in this good financial shape. By the way, the job comeback is what you would expect. It's where jobs were lost: leisure and hospitality, trade, education, health services, professional and business services. But the number of jobs being recovered is what you expect given where jobs were lost. So consumers, I think, are in pretty good shape right now. Business, I think, is also in pretty good shape. Strong consumer demand. There's a need to replenish inventories. There's significantly disrupted supply chains that are going to take a while to fix. And lack of workers, this is a significant issue. And there's also the last mile issue. Exactly how you get the stuff off the boats. Do we have enough dock workers? No. Do we have enough truck workers? No. Do we have enough truck drivers? No. Do we have enough trucks? No. And union problems and regulations, especially in the California ports, are a real problem. All right, so retailer inventories are considerably lower than one would expect and have not been able to be replaced. So when supply chains do start to get fixed, not only do they have to have enough gas to meet current demand, which is going to be strong, but they also have to have enough gas to replace inventories. So you're going to have factories around the world basically running at full bore to get things going and to replenish inventories. In fact, my big concern now is not in the near term, but whether we're going to end up with too much production because there's so much that has to be made up. But right now, this is what we have. Supply chain issues, well, I'm not sure I've ever seen a meaningful input-output matrix of the supply chain. But I do know this, that global supply chains feed one another, that shortages of one product or component create shortages and price swings in other products and other factories that make them impossible to operate. And to fix this, lockdowns and other things that affect the ability of a plant to run effectively and to get its product delivered have to get to normal. And it's a worldwide issue, and it is not likely to be corrected in one fell swoop. It's going to take a while. There's also a question of labor. We're going to see slower GDP growth now than we otherwise would, but that will probably speed up GDP growth as the problem gets resolved. And also keep in mind that there's upward pressure on prices now for a lot of goods and commodities. Those prices will fall once capacity comes back online, but they are not going to get back to where prices in general are going to be at a much higher level once this is resolved. And the timing of this is uncertain. We'll talk about that. Let me talk about housing, because I think it's significant now, especially in the US and Canada. This is one of the major problems. Again, we hope to be the first one to buy and then object to the other 199 being built. That's all too true. The first decade of the 21st century, we overbuilt housing. The second decade, we so underbuilt housing that vacancy rates are as low as they've ever been for single family homes and for rental vacancies. It's just amazing how low they are. And now we're very short on inventory. How short? Not only is demand near record level, but we have a big hole to fill. How big a hole? There is annual demand for about 1.4 million housing units in 2022. And this is in addition, this is to the amount of shortage that exists. Depending on whose number you look at, the national shortage is estimated to be somewhere between 3.8 and 5.2 million units. That's both single family and apartments. And the only way out of this is to build more units, because right now we are just barely keeping up with demand, and we're not eating into that shortage, which has caused this supply-demand imbalance is what's causing prices to go up rapidly. Ultimately, it will resolve itself, but if you wait for it to resolve itself, it's 5 to 10 years down the road, and prices are going to be incredibly high, and affordability is going to be incredibly low unless we do something about this, because it's a big hole to fill. You obviously all know about the big run-up in home prices. To give you some data on what's going on with supply, in 2015, there were 3.9 months supply, which is fairly normal. It's down nationally to 1.8 million, but I think that number is overstated. And the number of homes for sale has dropped from 1.6 million to 550,000. It's all about affordability and demographics. This is existing home affordability, and this was through the first quarter of 21. As this is, you take a look at it now, it is much lower, and it's about to plummet. We'll talk about this. And again, through the fourth quarter of 21, the Housing Opportunity Index is now the lowest it's been since 2008, and it is plummeting. We'll talk about that. So in 2015, the U.S. average, I don't know why Houston is circled, was about 64%, which is very good. This simply is Housing Opportunity Index is what percent of people in an area can afford the median priced home. And so if 61%, excuse me, the US number is 64% can afford the median priced home, that's great. Now it's down to, in the fourth quarter, it was down to 54%. The first quarter number just came out and it's down to about 52%. And Zonda did an estimate of what it would look like in 22, depending on the rate of price increase. So I'm assuming between 10 and 15%. With 3.5% interest rates, it drops somewhere between 44 to 46%. At 4% interest rates, the 42.44 to 44%. So a lot lower than it's been in years, and it's even worse. We, because I'm in Phoenix, we ran it out for Phoenix to see what it was going to look like 5 years from now, using price increases that are not outlandish. And what we found is that we expected the fourth quarter to come in at 47%, came in at 44%. And by the end of 2025, unless you do something to slow price increases, we're going to be in the 20s in terms of affordability. And by the way, this analysis assumes the fourth quarter mortgage rate of 3.15%. So if anything, I'm being optimistic, as ugly as this looks. By the way, U.S. home affordability is up 100, the median priced home is up 138% since 2000. Median incomes are up about 60%. But mortgage rates are down 61%. I doubt there's anybody listening to this today who believes over the next 20 years, mortgage rates are going to fall another 61%. And that's going to put even more, again, pressure on affordability, because it's that decline in interest rates that have kept things affordable until now. The primary reason that housing, again, remains affordable is interest rates. And what happens if interest rates go up, which is highly likely? Well, that's what happens. Affordability is not a terminal issue now, but it's going to become one very soon. And the shortage affects all types of housing across all price levels and across all income levels. And it's got to be cured. And it's difficult to cure because municipalities face, on the other side of this issue, NIMBYs. They face lethargy on the part of their staffs. They're understaffed. There is not enough labor in the United States today to build all the homes that are needed, and there are still supply chain issues. So it is an ugly issue, and it's not going away. We are undersupplied in existing homes, new homes, and apartments, and this is driving people to the new home market, except they take a long time to deliver, and it's going to force people into the rental market. So again, demand. Let's take a look at population. The mode of population, the place where most people are, basically are in 26 to 32. The only thing you have to understand about this is the horizontal line, the upward sloping horizontal line, which is an oxymoron, but basically shows when people buy houses. And people buy houses en masse from 29 to 34 are prime home buying years. This is what, and the blue lines are age. So you can see that as of today, the big jump, the mode, has not gotten to where they're prime home buyers. Let's take a look at it 5 years from now. Now you've got all these people in prime home buying years, actually when they would be buying homes. And most of them are going to be millennials. Again, as you age, the propensity to buy a home goes up rapidly, but it goes up most rapidly from when you're 25 to when you're basically 35. And that's what we're going to have this big jump in 25 to 39-year-olds. And that means a lot of people are going to be buying houses. It also is interesting that between the 20s and 30s, you have the biggest jump in your income. You know, it's not your maximum income, that comes in your 50s, but the biggest jump in income that allows you to buy homes is during the 20s to the 30s. It also, given COVID, there's a lot of people who saved enough for a down payment. Supply, again, month supply, it's way below normal, and it shows no sign of abating. And because of this huge supply-demand imbalance, apartment rents in the US last year were up about 18%. Resale housing was up 15% when core inflation was up 6%. There's a supply-demand imbalance we got to deal with. The good news is demand is going to remain strong. It's like a ladder. People at the top, if they can't afford it, they go down a rung or two to something they can't afford. People in the middle, they will do the same thing. They'll go down a rung or two. People a little lower might have to stay in build for rent or apartments because they can't afford a home. People at the bottom, they got real issues, and we're going to see a lot more homelessness if this occurs. It's a very serious issue. So here's what I see happening because of the affordability situation. Fewer potential buyers that can afford the median priced home. Fewer people will own, more will rent. More people will rent single family units, and you'll see a lot of doubling up, 2 families in a single family unit. More millennials and Gen Zs living with their parents, but really the big thing is more parents are going to be living with their kids. Homes will be smaller. You're going to have more density. And you're going to have fewer worker income housing units. And this is a problem because where do the policemen live? Where do firemen live? Where do teachers live? Where do nurses live? Where do the guy who's at the 7-Eleven work live? Where do construction workers live? Where do the factory workers live? It's a real problem. And C&D apartments are going to get less maintenance, again, more homelessness. And all this creates a worsening economic development picture because the ability of workers to go to expensive cities diminishes. It's going to mean upward pressure on wages and city budgets, and it really implies a decline in real incomes. Once supply and demand is back in balance, and that's no easy task and won't be accomplished overnight, prices should normalize, but at a much higher level. There are 7 things that you can do to end the housing shortage. Okay, there's only 7 things, and here's what they are. You can build more housing units, or 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 you can build more housing units, ad infinitum. Don't talk to me about rent controls. It hasn't worked anywhere in the country. It actually causes the number of units available to decline. And so it's more housing units. That there's such a shortage, that is the only solution. And again, will 22 and 23, will there be a serious downturn in housing? I think demand's too high and the inventory's too low. But I think people move down that ladder as mortgage rates move up. Again, more density, smaller units. We need to shorten the development process at all levels of government and allow technologies that shorten the cost and the time to build. And that's not an easy task. All right, let's go on to inflation, okay? I'll give you a second to absorb that one. I can hear you laughing now. Okay, so stocks are at near all-time highs. Housing prices are all-time highs. Wages are at all-time highs, and they're accelerating. Job openings minus unemployed, all-time highs. Inflation is at the highest level since 1982. Yet, at this point, fiscal and monetary policy has been extremely expansive. Quite frankly, Alfred E. Newman could oversee the employment increase we've had. It's a natural phenomenon of ending the shutdown. But for government to continue to inject liquidity into the system until now, and basically spend trillions at the same time, given the supply-demand dynamics we have, I guess I'll be blunt, it borders on insanity. Here's the monetary base. Took basically from 1913 to 2009 for the monetary base to reach $1 trillion. The Fed, to their credit, has saved us from at least 3 economic debacles since 2007 that I'm aware of. Obviously, the monetary base jumped because of what happened in 2008, the great financial crisis, jumped from 1 trillion to 4 trillion, and that worked. Then it dropped to close to 3 trillion. And then because of COVID, it jumped to 6.5 trillion. So now all the Fed has to do is drain trillions of dollars of liquidity where assets were, because of the structure of interest rates, where people looking for investments were forced to take a look at riskier assets, and all they have to do is drain it without starting a bubble and without pushing interest rates so high that it causes a recession in an election year. And so here's Jeremy Powell. They're going to move rates up from almost zero. The Fed's goal is not a recession. It's just fine tuning. And this is not the 1980s. Those are Jeremy Powell's quotes, and I respect him. He has done a great job, but he's got a difficult situation now. My quote is, good luck to you. We're in uncharted waters, and it's possible we get out of this unscathed. I think that is a less than 50-50 event. Inflation has caused the Fed to turn more hawkish, and we'll talk about that. Beware of a wage price spiral, because once wages, if inflation becomes embedded in wages, it's tougher to stop. Also, the Fed does not control the supply chain, and that's an issue in terms of where, especially where inflation shows up. Is the labor availability to solve the supply chain issue in reasonably short order? Is it there? If not, the Fed's going to have some hard choices. A major factor is going to be declining real incomes. And again, ultimately, shortages lead to gluts. I'm not sure that's a problem for this year or next, but down the road, time will tell. So cap rates for all you real estate guys. Cap rates are a function of interest rates, but mainly liquidity. And as the Fed tries to dry up the extent of the liquidity that has kept the markets so buoyant, liquidity is going to lessen and interest rates are going to go up. And I think this is going to put pressure on cap rates as well, something to consider. So first thing all you Keynesians learned the first day of school was that inflation is too much money chasing too few goods. I think too much money pushes prices up, and too few goods determine where inflation shows up. So it's basically every way you look, whether you're a monetarist or a Keynesian, we got issues with inflation. Our policy response was more than made up for. It more than made up for the incomes lost during COVID, probably by a factor of 3, but it didn't replace the goods the income were supposed to produce. And so you have all this money, but you don't have the goods. So prices went up. What a surprise. Household balance sheets are in better shape than they've been in a long time. Demand elsewhere has surged as people spent $5 trillion as the money was tossed out of helicopters. I don't know how many of you are familiar with Milton Friedman's article from the 70s about what happens if you just threw money out of helicopters. Well, what we have now is what happens. By the way, that stimulus accounted for 25% of GDP and 30% of the pre-pandemic federal debt. The Spendathon brought to light shortages in the supply chain. Among other issues, there aren't enough workers to unclog it at any time soon. You've all seen this in your local food store, I'm sure. There's also hidden inflation in the service sector. I'm sure that those of you who took out your significant other last night on Valentine's Day did not get the service in general that you normally would have expected. That's a hidden cost. The other thing is the way the CPI is constructed, a lot of the inflation in housing has not even shown up in consumer prices yet. That's in front of us. Last year alone, the government spent $1.9 trillion on the American Rescue Plan. That was supposed to create 7 million jobs. Created only a few. And then the infrastructure plan, fortunately that 1.2 trillion will be spent over the next several years, as it takes a long time to get this stuff shovel ready. The words of Barack Obama. But what you have to realize, there are literally billions of dollars that haven't been spent of the COVID money that's been was planned to be spent, and so essentially there's lots of stimulus still out there. And again, having promised that we only have transitory inflation, the Fed currently has no really good options in dealing with it. raising interest rates too rapidly, you send it into a recession in an election year, and will increase the cost of borrowing, because people were so confident that the Fed and the federal government, that instead of financing all that debt in the long term, a lot of it was short to intermediate term. So it's going to squeeze out other things now that interest rates are going to be going up. On the fiscal side, cutting social spending, again, politically unfeasible. Raising taxes could undercut economic growth, because Biden's taxes are not a tax on the rich, they are a tax on the upper middle class. By the way, they're also a tax on the rich, but mainly it falls on the upper middle class. Overall, the Fed's promising to slow the purchase of assets and to allow its balance sheet to run off. Following the first hike in the Fed funds rate, which should be coming up in a few weeks, the Fed has a very difficult task in front of it. They will have a more difficult task if the fiscal policy remains wildly out of control. The Fed's saying 3 increases in 22. My guess is it's going to be more than that, or there'll be more than 0.25% increases, and interest rates are going up. Question is how much and how fast, and it's going to be a touchy-feely situation for the Fed. It's going to be interesting in view of how strong consumers are right now and how weak the supply chain is. So this is the government, and this is what's happening. This is annually. Quarterly, some of the outlays ran into the 40s, but essentially the government has gone from about 20% of GDP to, on a permanent basis, about 25%. And this doesn't take into account any of the proposed taxes. This is what is today on the books today. And receipts, which usually are about 18, 19%, basically are approaching 20%. And that's, again, what's on the books today. If you make a lot of money, the government wants more of it. The devil's in the details. My suggestion to you, depending on what is reintroduced in Congress, see your accountant soon. And again, don't think you're out of the woods. If you're an upper middle class guy, if you and your wife both work, chances are the government will be knocking at your door. The jury's still out on inflation in the long run, but price pressures will ultimately ease as the supply chain normalizes. But this is going to take a while. I think that inflation is with us at least through 22 and 23. This is the PCE. This is what the Fed looks at, which is why I'm looking at it. And you can see the jump. But the one that scares me even more is this. The weighted overall wage growth tracker basically is showing that inflation is getting into wages. And quite frankly, anecdotally, I hear nothing but people skipping jobs and getting a 25 or 30% increase in the new job. You didn't hear that, Leo. Leo, my numbers guy's here. And but that's why so many people are switching jobs. So it's more than gasoline, but this is the way people feel, I think. Incentives matter. Increased taxes and tougher regulation will clearly result in slower long-term growth. Initially, it will be difficult to see due to the high level of pent-up demand and fiscal and monetary stimulus, but it will occur. So, all right, that's the negative stuff. So how does it look overall when you balance all this stuff? Consumers strong, businesses strong, housing strong. Fed policy going from highly stimulative to mildly hawkish, at least in theory. Fiscal policy still highly stimulative. So in the near term, the demand side should be strong. And despite all these risks, my take on it is no worries. That basically consumers are in great shape, businesses in great shape, housing demand is strong. We're not looking at another 1980s episode, at least not in 22. 22 is an election year, and hopefully fiscal policy gets under control. But I think it's going to be a decent year. I believe the forecasts that say that it's going to be a well above average year in the mid to high threes in terms of GDP growth, and that 23 will be an above average year. So, you know, it's not Valentine's Day, but happy Valentine's Day. Unless there are some really poor political decisions or some black swan event, I think we're in good shape. That's apparently the end of my presentation. For those of you who are still awake, I'll be glad to answer any questions.